We spoke with the Cleveland Federal Reserve President and FOMC voting member, Loretta Mester, on Friday. She talked about the Fed and gradualism.
We don't have a meeting until April, and I want to see all the data that's coming in. I do think that my best guess at this point is that the economy will evolve in a way that will entail bringing interest rates up gradually sometime this year. But when it is, how many, I can't tell you at this point. I just can tell you that I anticipate that economic developments will entail sort of continuing on that gradual normalization path this year.
You wonder if the Fed and central banks in general become less relevant in this environment. Joining us right now is Raymond James Chief Investment Strategist Jeff Saut, along with Federated Investors Chief Equity Strategist Phil Orlando. Gentlemen, good to see you. Thank you so much for joining us.
Thanks for having me.
First, let's talk about the Fed and then the backdrop. Jeff, gradualism means what to you? What Loretta Mester was just saying. Is that 2 increases by the Federal Reserve this year, you think?
I came into the year thinking that I'd be shocked if there were any more than 2 increases in the federal funds rate. Right now, I don't think there's going to be an increase until after the election.
After the election, because typically the Fed doesn't want to get involved in an election, right, Phil? Because you got June, that's one possibility of an interest rate hike. You got September, but that's right before the election.
Well, the Fed would prefer not to do anything ahead of an election, but they will certainly change policy if necessary. In terms of Loretta Mester's comments about, April or possibly June, first quarter GDP, according to the Atlanta Fed, is only going to be 0.6%.
Wow, that low.
Yes, corporate earnings for the first quarter looks like it's going to be down 5 to 10% year over year. It's inconceivable to me that they could tighten policy in April given those kinds of numbers.
Yeah.
And probably June might be too early. So our best guess would be 1 or 2 hikes maybe, but certainly in the back half of the year.
You're putting together a backdrop, John Hilsenrath, of the economy that looks like it's growth, but it's slow growth. Now, Donald Trump said we're going into recession.
Right.
That's not what
that's not what Wall Street is telling you. If you're showing S&P 500 numbers right now, the market is coming back. It is what the market is telling you is a very slow-growing economy, and that's what the Fed's expectation is. I'll tell you what, though, if Donald Trump renegotiates $19 trillion worth of debt, then we probably are going back into a recession. I just want to push back on one point, that the Fed doesn't want to do anything before an election. If you look at the way they've behaved in the past. In 2012, they started moving towards ending their QE program in 2012. In 2008, they allowed Lehman Brothers to end right before an election.
True.
In 2004, they started raising interest rates before an election. I think if they see the economy moving in the way they expect, they'll move in June. But you raised the really important point, which is, are we going to get the numbers that they want? With 0.6% growth in the first quarter, we've been through this almost every year the last few years. Are they going to be saying, oh, boy, maybe we're heading into another slowdown. We need to hold off.
Not a good number.
To some degree, there's some seasonality in the numbers. Now, they were supposed to have fixed that a year ago. There's some question as to whether or not they did. So you tend to get a sort of a punk first quarter, and then the numbers start to come up. So if we can get a better set of data in the second quarter, both corporate earnings and economic growth, then that sort of, I think, brings September into play. And I agree with John. I don't think the Fed is going to not do anything because of the election. If the data's there, I think certainly a hike would be warranted.
I'll tell you what vote matters more for the Fed in June than the presidential election, and that's the UK voting on whether to stay in the EU. Because if they're worried about financial turmoil, financial instability in June around that vote, then they might say, well, let's just wait a little bit longer to get away from that.
That's June 23rd, and there's actually a fair amount of skepticism out there that they stay in. I mean, I think a lot of people feel like the UK is actually going to leave the EU.
It's June 23rd, and there's a meeting right before that.
Exactly.
So I was at Yellen's lunch last week. John, you were probably there as well. Now,
I was supposed to be there, but I had to pull out.
I was looking for you on the dais. I didn't see you. So, everyone talks about the dual mandate, inflation and unemployment. But what Yellen spent time talking about was concerns about international, concerns about financial market volatility, and certainly the potential for Brexit in June would certainly fall within the category of both of those.
So that's another unknown. Jeff, let's talk about putting money to work here. So if we're getting this kind of slow but certainly growth story, but still slow, do you want to own stocks in this environment? What a huge March month we have.
I absolutely think you own stocks here. I think when people start seeing losses in their fixed income portfolios, which I think you're going to get in the back half of this year, I think you will see the individual investors push chips into names that they know, dividend-paying stocks, stocks that have increased their dividend by 10% or more forever.
Yeah, because part of the reason for the rally that we saw in March, Phil, was people just felt like we had gotten so negative earlier in the year that it was just a bounce back.
Well, you had one of the worst starts to a new year in history. I think we were down 11 or 12%.
That's right.
And we were sort of discounting recession. The economy started to put some better numbers on the board, and we had a pretty strong bounce back. But to that point, with punk first quarter GDP and corporate earnings not so good, we may see a little bit of a correction here before we resume higher.
All right, we'll leave it there. Phil Orlando, Jeff Saut, good to see you both, gentlemen. Thank you so much. We'll be right